to it. Julia, plenty to discuss. Let's start with the headline. The market in the end closing down about 0.4%.
James, once again, it's macro concerns which is driving the market at the moment, and unfortunately that's been bad news for risk assets. We've seen the Australian market down by 0.4% today, and of course we saw the Aussie dollar reaching below parity overnight. In fact, risk assets sold off across the board with one exception, and that was gold, which saw an increase because of its status as a safe haven. So if we have a look across the market, I guess the main concerns are in regards to this EU summit on Thursday and Friday, the fact that Greece won't really be having a presence there, and the fact that Germany still seems to be at the opposite spectrum of opinions compared to the likes of France and Italy. So altogether, that EU summit, I guess, have investors and the market a little bit nervous. It doesn't look like we're really going to see concrete solutions coming out of that at a crucial time for the Eurozone. We saw Moody's, of course, coming out overnight to downgrade Spanish banks. So all up, it wasn't surprising to see that the best performing areas were some of those defensive areas, healthcare as well as telecom. And we've really seen that throughout the last quarter, as well as the last year, that these have been the areas which have benefited when we've had these macro concerns surfacing. So all up, a bad day for growth assets. Once again, we saw energy as well as the material space the worst performing, and disappointing volumes. Yesterday, only $3.7 billion worth of stock being traded. Today we saw only $3.5 billion worth of stock being traded. So unfortunately, these macro concerns, not good news in terms of volumes.
With CMC's camera, we'll bring Michael back to finish off those comments in just a minute. Let's move on to Julia. Look, just hearing from Michael there, and I suppose both Jeremy as well, in terms of a thinning of the numbers, if you like, in terms of the bulls. Where do you stand, Julia? I mean, where are you leaning towards?
James, I caught up for lunch with a colleague in the markets yesterday, and he almost made me cry, and he said that 4,100 is the new 4,400 on the markets. So I guess that tells you about the psyche of a lot of the players in the market at the moment. But we are coming up to the end of the financial year, and at some point in the cycle you start to see a shift from those defensive areas into some of those cyclical areas, but we haven't seen that shift yet. And that's really been reflected in the numbers for the full year as well as the last quarter, where once again we have seen the telecom sector outperforming in the last 3 months as well as the last year, while some of those cyclical areas and those areas tied to global growth in particular, like the materials and the energy and the industrial space, have been beaten down quite a lot. In the last 3 months, though, it has been quite a transformational time on the market as well. We have seen significant cost cutting, a lot of restructuring, some of those structurally challenged areas like the media sector, like the steel area, as well as the retailers. And we've seen capital raisings from stressed areas, as well as some renewed interest in M&A activity. And I guess a key question for market participants is, when do we start to see the shift from those low beta defensive areas into some of those more cyclical areas? So the big question is whether it is time to go into what's looking extremely value-driven cyclicals, or whether we stick to some of those macro themes and stick to the defensives. And unfortunately, the market sticking to the macro themes at the moment, the macro concerns and those defensive areas. At some point in the cycle, though, we are going to see a shift into those higher beta areas. The question is regarding timing at this stage, and those cyclical areas are looking extremely cheap at the moment, as long as we start to get a cyclical rebound and we start to get an uptick in the cycle.
Level of short positions in our market, and in particular, as Michael mentioned, the level on JB Hi-Fi, incredible.
James, it's understandable, because taking out the macro concerns and the cyclical areas of our market are suffering. Over the last 6 months, UBS had a report out today. In the top 100 companies, we've seen 35% of those companies come out with a downgrade of 10% or greater. So while we do have macro concerns, we are also at a time in the cycle where companies are undergoing a lot of pain. What we have seen as a reaction is a lot of cost cutting, a lot of restructure. And the good news is, once we get an uptick in that cycle, then we will see some of those cyclical areas benefiting quite sharply, quite strongly. But the last 6 months, we have seen earnings expectations being cut. And when you see those earnings expectations being cut, well, valuations on the market also adjust. And that's why it's been so painful. So if you do believe in fundamentals and fundamentals that drive the market, well, the last 6 months have been very difficult for cyclical companies. The flip side is that they're looking cheap because we have seen prices fall so much, but really what the market's looking for is a bottoming in that earnings cycle falling and really that uptick to come. And we've seen the fat now being cut off, and hopefully when that rebound comes, it'll be a strong earnings rebound for those companies.
And Julia, wouldn't a lot of that have to be a shift in the fundamental sentiments around the market, because a bounce on short covering can only get you so far?
Absolutely. We need the earnings to come back, and really if we have a look at some of those cyclical areas like the retail space, like the media space, they're not only undergoing some cyclical concerns but also some structural concerns, and we've started to see that being addressed, especially in that media space. So the next 12 to 18 months is going to be an absolute crucial one for that media space to transform and transition to, I guess, the new media, what's been new media for a while now. And we are expecting to see a bit of volatility in earnings because of that. There's going to be investment, there's going to be restructure, and the market's going to see whether we are going to start to see earnings bouncing back. But the last 6 months have been a very difficult one. In fact, the last 12 months have been a difficult one for cyclical stocks, and really we want to start to see a rebound in the cycle. The good news is that we have started to see interest rates come down in Australia, and usually that's one of the first signals to come that we are about to see a turn in the cycle. And usually a cut in interest rates, well, it takes about 6 to 9 months to filter through. We saw our first interest rate cuts here in Australia for this cycle back in November and December, so we are expecting to see some of those effects filter through now. So 6 months to a year would be now to the end of the year. Hopefully we'll start to see some of that filter through.